from New Constructs. And with me today, I've got David Traynor, the founder and CEO of New Constructs. CloudQuant is an alternative data provider. We also do extensive research into the data sets that we provide through our enterprise data warehouse and our data fabric. And today we're going to talk about some of the research that we've done into New Constructs, and also meet with the founder to hear about the history of the company and how they've created this really intensive forensic accounting service that they provide that generates this data set. So let me pass the mic over to David Traynor, and he can make an introduction.
Hello, David Traynor here. Nice to meet everybody. Thanks for having me on the call here, Morgan. Excited to talk about our new technology for collecting data from filings and how we have turned that into an idiosyncratic signal for our clients. I got started on Wall Street. I was at Credit Suisse during the tech bubble, and I saw, sort of how the sausage was made, and realized that if someone didn't really develop a technology to actually go through and read all the filings, especially footnotes, maybe nobody would, at least not with any kind of scale. So I created New Constructs around 20 years ago and developed technology to go through filings. We've since scaled that technology up and perfected it, and now we're producing this data set that we've partnered with CloudQuant to demonstrate provides idiosyncratic alpha in a lot of different ways. We're excited to talk about that today. So yeah, I mentioned I started the business a while ago. In 2003, we built the original technology, and we focused really on our institutional client base. Back in those days, it was all about building the best-in-class models for sophisticated institutional portfolio managers. Think about it as a service that would create the financial model that you would create if you had an infinite amount of time to do nothing but read filings and build a model. And that's really what our technology is designed to automate and to support. From 2008 to 2015, we were a hedge fund. And then in about 5 or 6 years ago, we really kind of focused back on the technology in order to focus on delivering a highly value-added data set like the earnings distortion data set. And what we've found in our own studies and in independent studies by firms like Ernst & Young, Harvard Business School, and MIT Sloan is that the reported earnings and analyst earnings, consensus numbers, can be off by as much as 20% on average for all companies in the S&P 500 and more than 10% for 39% of the companies in the S&P 500. So these are material differences that our data has versus the other legacy data sets. And it's because we get data from the footnotes that nobody else gets.
David, would you expect that to be worse for small and mid-cap names, or less severe?
It's there are no like sort of strict patterns on a lot of this stuff, except that we find in the super small companies, penny stocks, there's not a lot of stuff hidden in there. Those filings are shorter and simpler. For some mid-cap companies, we see huge distortions, but for the most part, the distortions, I think on average, Morgan, the answer to the question is yes. It's more in the big companies with the complicated filings than it is with the smaller companies.
So maybe they're a little bit more sophisticated and they have the skill set to create all these accounting gimmicks. So yes.
There's more complexity in the organizations, which creates more sort of, dark corners for footnotes to hide in.
Okay, very interesting.
Next slide. Awesome. Yeah, I mean, I think one of the things we all are seeing in spades these days is that, look, the legacy traditional research models don't really work in tough markets. We have a research division. We've been calling out several stocks. I think we have up to 17 or 18 stocks on our zombie stock list. And it's been a very popular product, helped a lot of our clients avoid blowups, because at the end of the day, we know we can't really trust the Wall Street ratings. That's what we're showing on the lower left-hand side of the screen. I think sophisticated investors are well aware of the fact that there's a lot of misinformation out there when it comes to most stocks. And the problem is diffusing or defeating that misinformation, is very time-consuming and difficult. You got to read filings that are 200+ pages. You got to be an accounting expert to understand what the filings mean. And the accounting rules are always changing. So you've got to be constantly up on what's going on with accounting. Otherwise, you could be missing billions of dollars in offset balance sheet debt, as we are now with this new variable lease and non-commenced lease gimmick that we found here in just the last few months. But the takeaway is, if you're not reading the filings, you're missing a lot of very important information. And that's really what CloudQuant has helped us prove. And it helps our clients actually monetize that incremental information. Next slide. So yeah, this one's a kind of a quick summary of how the system works. We take the filings the raw filings directly from the SEC, and we have proprietary data that goes through and automatically parses everything that the machine can recognize. The machine's recognition is based on having tracked how experts have parsed well over 100,000 filings. And so that's what we call machine learning, really following the library of instructions that were created by expert analysts. That data goes into very specific, what we call bucket system or bucket structure, which is how we categorize the data for the purposes of modeling and analysis. And if you read the paper that Harvard Business School and MIT Sloan wrote, one of the key takeaways from the professors is that New Constructs does a better job of categorizing the data. I know there are a lot of firms out there that use AI, in quotes, machine learning to pull all the data out of filings, but that doesn't really do any good. I mean, that's like digital needles in a digital haystack. I mean, you need to know what the data means. Categorizing accounting data according to its underlying economic meaning is our specialty, and doing it with scale. And that's why you'll see that we are trusted and proven by these major institutions who wrote papers proving the superiority of our data and our models, return on invested capital models, free cash flow, core earnings, every measure of profitability. We do it better than anyone else because we're getting more data out of the filings, and we know how to use that data to better understand the business.
How many different categories of distortion do you actually bucket these needles into?
There are like 13 pre-tax and I think 11 after-tax. We also distinguish between those that are hidden in the footnotes only and those that are actually you can find on the income statement. And what the studies have shown is that only about 30% of the time are the legacy data providers even getting the income statement categories right. And really the main distinction we're making in that Harvard and MIT paper is just that they want to get the distinction between unusual and normal, or operating and non-operating.
Yeah. Good. Any last comments before I dive into our research here?
I just want to say that there's an enormous amount of work that has gone into pulling this data set together. It's never been done before. And we're really happy to be working with you guys, Morgan, because we're great at pulling out the data and crunching those numbers, but we needed someone with your expertise to show us and show our clients how they can monetize this proprietary signal.
Yeah, now that we're working together with New Constructs now for over a year, this is an example of how you can get access to their data set through Liberator. And you can kind of see what some of the fields look like. I'll page down to the next page, show you some of the fields that are provided. This is really just trying to get at the concept of what part of this earnings report and this reported earnings is actually repeatable, and what part of it is some sort of accounting gimmick that probably is never going to be seen again. And so we've looked at these numbers over the last 10 years. And we've come up with some results that we wanted to share today. Another thing that, David's, not really called out, but I will, because having worked with him for so long, we know kind of how difficult it is to stay on top of things during earnings season. So we actually measure the performance of his group in turning the filings around within a certain time frame. There can be, during peak earnings season, hundreds of earnings filings that need to be processed, and to have the technology and manpower and expertise to forensically analyze that at scale is a unique skill set that they have. And so we do track this, and we see that they have very good turnaround time, and the average is around 2 to 3 days. from the time the filing hits. So they're going through, this 200-page plus filings and scanning through and pulling out all these little nuggets, within just 2 or 3 days. So that's pretty incredible. And I think it's worth calling out. And that's why there is, I think you'll see some edge to the product here. So here's a description of some of the fields. We'll distribute this later. You can read up on those, but they're really looking at, we're going to focus on total earnings distortion and a little bit on hidden distortion. But there are some other fields there that are worth looking into, in particular in certain sectors. So let's talk a little bit about, what we're trying to do here. We're trying to basically identify the repeatable part of the earnings. There was a paper from Harvard, MIT. They found some interesting things. One of the things they found was that the amount of non-core earnings or one-time items was going up over time. And in fact, they see that across the board, across all market caps. You see that they're using these one-time items to manage their earnings, because they know that the companies that miss earnings are going to be punished. And so that's a skill set that C-level people are picking up. And you see that, as David mentioned, 19% of the reported net income is coming from one-time items that are unlikely to be repeated. Let's see. Some of these other statements are more statistical. I know we probably have some very quantitative people and some more fundamental people on the call. I think that, the core earnings should be repeatable. That means that it has a high AR1 coefficient, which means it's just highly correlated from time period to time period. The earnings distortion components should have almost no correlation from quarter to quarter. So that's all that means. And so there's a lot of different applications of this. I'm going to you can read the MIT Harvard white paper. I kind of summarize what some of the results are. They do talk about where these one-time items are showing up. And so they track, where they're showing up over time, where they're increasingly showing up over time. It's interesting that they're basically hiding them in places where you wouldn't look. And then they also do some analysis of what are the existing products out there that you can buy, and how does this stack up against it? And statistically, what they showed was that New Constructs core earnings is much more reliable than any other thing that they tested it against, from all the usual suspects. So this is a product that is unique and better than other things out there. And so that's what, you can take away from that paper. This is really just a panel showing that core earnings is more useful for predicting pretty much any measure of earnings that you want. Core earnings is one of the best factors for doing that. We do have an index where we track earnings distortion. It is a little bit lower than it was recently. And, a lot of times these cycles come from, companies deciding that they need to build up some sort of cushion, or drawing down on that cushion to meet their earnings. And so we see these cycles from time to time as companies go from good times to bad times, trying to smooth things out. We did back tests. The assumptions were that we're trading companies with 100 million in market cap, 1 million in average 20-day trading volume, and they have a minimum stock price of $4. We're going to rebalance on a daily basis. It doesn't mean we trade everything on a daily basis, but it means that we would trade in and out of things opportunistically if the signal tells us to. The signals we use are very simple. We're simply doing rankings. So quantiles, we're ranking things from high to low, and we're looking at the extremes. Trade expression is market on open on the trading day following the signal. And we're using a very simple portfolio construction, so nothing fancy going on there. The experiments we ran really tried to explore some of the basic questions you would ask as a trader in terms of how you would decide whether to use this signal or data set. So we've created signals from this data set by trying different columns in the data set and seeing which ones were most predictive. And so we're showing you some of the highlights of the things that we were able to identify. And so we're going to go from a very simple back test and gradually dial into more detailed analysis as we start to find the alpha. And here's just a visual representation of the different variables that we tested out that we'll show here. The first test we did was just to take the total earnings distortion number out of the data set and rank them from top to bottom, and then look at the performance of each 10% or quantile or decile of that ranking. And what we were hoping to see was that decile 0 and decile 9 have a big difference between them. That gives us the opportunity to kind of make the judgment that there is some edge here between the two in the extremes. But what we see with the total earnings distortion, there isn't any. It's not monotonic, is what it's called. If you see a nice curve where it goes from low to high or high to low, then you can tell that that it's monotonic, and in this case, it's not. So that wasn't very useful. So we tried something else. And why would an earnings distortion total not really be useful? Well, companies are all shapes and sizes, and so the total amount of their earnings distortion really isn't all that meaningful. You need to scale it by some factor that has a function of how big the company is. That way we know on a percentage basis how much are they really distorting things. So if we look at normalizing that by market cap, then that gives us the ability to find some separation here. So here we see the return for the 0 and the 9 have a quite different profile, and that's a little bit of the monotonicity that we're looking for. So what do we take away from this? Well, this is a data set where extremes matter. If you're going to focus on using signals from this data set, you want to look at the outliers. The ones in the middle probably aren't that informative in most cases, although we do find a few exceptions. And so you really want to be focused on the tails of the distribution. The next experiment was looking at just, the small cap symbol universe. We wanted to see whether it was more or less effective in small caps versus the entire stock market. Our suspicion was that small caps are maybe a little less efficient. They have less analyst coverage, if any. And, the analysts that cover them, they may not even have the time to go through and do what David's team has done. And so, maybe there's some edge there. And so, in fact, do find that there's some edge looking at the 0 and 9 quantiles. We find that there's, we'll call it 50–60% return opportunity between the two from 2015 to 2022 on a market neutral basis. If we look at this in a chart form, this is just comparing the original backtest from the second experiment to the third one. And so we see that the small caps do outperform the rest of the stock market using the signal. The next experiment, we wanted to look at the extreme quantiles and see what would happen to the returns if we look at more and more granular quantiles. If we look at the top 10% and bottom 10%, we see that there is some separation between them. And that gets more and more extreme as we look at a smaller threshold or a higher cutoff. And so, as I mentioned, the further you get towards the tails, the stronger the strength of the signal is. And so if you're a single stock trader, for instance, and you're looking for just a couple of ideas each day, then you're really going to want to focus on the extremes. And you'll end up getting just a few signals a day. So if we look at how that stacks up, you can see really you start to get some real separation here between the backtests by just looking at the top and bottom 2% instead of 10%. You can really add a lot of juice here. How does it do across different sectors? We find that there are definitely some patterns, and there are probably some sectors where it may not be an effective signal. But in general, we obviously see that consumer staples and materials and industrials during this time period, and even to some degree, information technology and consumer discretionary during this time period showed that they worked well and had some positive edge. The next experiment we ran was with the small cap universe, but we wanted to filter out some of these sectors that we saw may not be very effective. Now, there is some history here. If you've done any earnings quality analysis, it's pretty clear that it's hard to do in certain sectors like financials. Just the way those companies operate and how they run their accounting, it's a different type of analysis that you do to figure out relative valuation and earnings quality. So we have some kind of outside evidence to suggest that this is a reasonable approach to exclude some of them from the performance. So we've rerun the backtest with some of the sectors that we know we have a suspicion they shouldn't work and didn't seem to. And with that, you're able to see that the returns, increase even more. And so now we want to combine that analysis and do just the top 2% with limited sectors and show graphically, what does that curve look like? So the next two experiments, we wanted to look at, cross-sectionally ranking things as opposed to just within, a smaller group. And so we look, or a larger group. So we looked within the sector if we could cross-sectionally rank them within the sector and improve the performance. In all, that wasn't all that interesting, but it was an experiment we ran and wanted to kind of see what happened. It looks like there is edge there. It's not necessarily meaningfully better. It was just, something we wanted to explore to see if that would be helpful. For experiments J and K, we looked at something that is very important. We wanted to know how quickly we needed to put the trades on. So keep in mind, the earnings call may occur, and then at some point the filings show up. And it could be, even as long as a week or 2 weeks later that the earnings filings show up, and then they can be parsed and they can be turned around by David's team. And so, we're really interested in, once the filings hit, how long before you need to have these trades on. Okay, so if we look at the day the filings hit, so time t equals 0, there is obviously some movement there caused by the filings. But now what happens, what happens afterwards? It looks like it's taking, about 25 days before it's really necessary to put the trades on. In fact, it looks like if you delay your execution by 25 trading days, you actually seem to have higher performance. So why is this? Well, the Harvard-MIT study found that the markets just weren't paying attention to this information, and that it wasn't being priced in immediately. And that's really supported by this evidence. We're not seeing that the market's pricing this in until after 25 days out. It's also likely that new information is coming out about the next quarter, and that's also being priced in. And management's probably even, maybe telegraphing some of this to analysts and things like that. So it really looks like, in terms of capacity for the strategy, if you're a long-term investor and have fairly low turnover, that this would be appropriate to put on larger trades, because you have up to 25 days to do so. So in this experiment, we're going to look at comparing a 25-day lag small cap top bottom 2% portfolio to everything else. And what we see here is it seems to do quite well and hold up quite well versus the trading, is immediately after the data arrives. And so it doesn't seem to really hurt us too much to wait 25 days or to even take potentially 25 days in a small cap name to put the trade on. Just keep in mind, a lot of these stocks are not all that liquid, so it may in fact take 25 days to establish a position. Experiment M is looking at the extreme quantiles, normalized signal, small cap, and we're going to filter out some of the sectors and lag for 25 days. And so we're applying all of the experimental learning that we have here to see, what you can achieve if you kind of identified the areas of the market where this is an effective signal. And with that, we see that new constructs seem to work very well for small cap names on the edge of the tail of distribution, and you can lag it up to 25 days. And you should definitely think about dropping certain sectors out. But with that, you can get some quite good performance. So here's a summary of the performance we saw. So in the end, you see a 21% return on a market neutral basis, which is very solid. You see, ranging all the way down to, 4% where we started with the all cap. So with really thinking about the problem of what we're trying to solve, what kind of data set this is, and using our brains, we're able to do some experiments and show that there are pockets of the market where it is very inefficient. There is a significant amount of edge. And even without doing any portfolio construction work, you can get a Sharpe ratio over 1, which is pretty impressive. We started looking at some of the results, and we felt like the information flow coming out of new constructs was very seasonal. We don't get updates from them all the time as we see this coming in day to day. We realized it's really driven by the filings. And so by making that observation, we decided to look at the performance of the portfolios during quiet periods. And when we do that, we see that, in fact, the performance was not positive compared to other days during quiet periods. And so we came up with a very systematic filter that would basically only turn the strategy or the signals on when we were in the middle of earnings, and leave them on until the end of earnings. And when we do that, we see that the performance goes up proportionately. So this is just a simple overlay signal that we applied that looked at the earnings cycles and really kind of just turned off or reduced the risk during the quiet periods to enhance the performance of the strategy. Now, it looks a little different than what we're used to looking at because it has those kind of flat periods. But I just wanted to explain what that is. There is a good reason for it. The reality is there's no new information, so there's no reason to keep trading. And so finally, how novel is this? We wanted to see, is this something that the market's already exposed to? Is this something that's giving us a different look, a different lens to look through? And so we did some regression analysis to decompose the returns against some known factors like value and size in the market itself. And what we find is that it really doesn't have any correlation to any of those. There is a little bit of factor loading on the market itself. And so you see that here with the blue line going up. And that's explaining some of the return. But for the most part, with these factors, we couldn't explain the returns, which means it's novel and it's not something most people are looking at. And with that, I think I want to look at a couple of more situations. So we did the risk decomposition for the small cap just to see, what that looked like. And we did some preliminary analysis to try and figure out what factors it had exposure to, and then just drop all the other ones so we could get better estimates as to what was explaining the returns best. And so when we do that analysis, we find the same kind of thing. We find that it has some loading on XLE, but most of the other ones were pretty much flat, maybe a negative exposure to XLK. XLK is the technology sector spider. XLE is the energy sector spider, for those of you who don't trade that product. USO is the oil ETF, and XLU is utilities, and XLP is staples. So we have we've identified that there is edge in this data set, that it is high capacity edge in small, mid, and large cap names. If you go further down the market cap spectrum, the edge is higher. But across the board, we were able to identify significant edge. And if you are thoughtful about which sectors you apply this to, you certainly can identify opportunities to trade this, both in the short term around when the earnings releases come out, but also in the much longer term. And so these are just kind of some of our final summaries. I think we're gonna probably pause here and open up for any questions we have. I think I've covered all the things that we plan to cover today. If you would like to get a copy of our slide deck, Marley, are we going to be distributing this automatically, or do they need to reach out?
Yep. Everybody who registered to attend will get a copy of the slide deck and then a recording of the session as well. And we have a question in the chat that I can read if you're ready.
Sure.
What is the holding period for these? Does it exit before the next earnings release or wait for new constructs data to come out?
The holding period is defined by when it leaves the threshold, the cutoff threshold that we used. And so it can be variable depending on the cross-sectional rankings. I think we have some data on that. I know Kevin, who did a lot of this research, is on the call. He may have those numbers available. If not, we can send you an email to answer. But I believe that
most of the time, Morgan, the ranking's not going to change until new data comes in. So
that's right.
It's going to be pretty much when a filing. We won't change the earnings distortion data unless we get new data. So you're looking at usually around a quarter, right? The time between Qs and Ks.
Right. So I could actually answer that. This is Kevin speaking. So for the back test we're showing you, and of course with the dashboard and matrix, if you look at the turnover, it's around 5 to 6%. And that gives you the average holding period for the stock positions in the back test is around 25 days to 20 day trading days. So that's about a month. Since, as David and Morgan said, that indeed the new construct only update their earnings distortions values if only there's a release or data is being correct, like new files being added to data set. And for the cross-sectional ranking, yeah, that does not change a lot, so that gives you the average holding period. But of course, considering the seasonality, there's also a test where we do try to stop the trading because there's not enough signals or more information coming to the market during non-earning seasons. So then the holding period would slightly change there. But overall, the average holding period is around 20 to 25 days. I hope that answers the question. And and the entering timing is definitely when the cross-sectional, the signals cross-sectional rankings comes into the threshold, and that's the start of the trading. And usually it will stay there for about 20 to 25 days.
I'd like to make a quick comment too on the, if we're done on that front, on the sector stuff.
Yeah.
Yeah, I just wanted to say, like, the sector exclusions, I think, biotech is probably a great example. Utilities are a great example, right? But really, what we were focusing on there is pulling out companies where earnings just don't matter at all, right? Like if your valuation, the stock is dependent on the results of an FDA, right, decision, and whether or not a clinical trial, how far it made it through or if it was successful or not, really doesn't matter what your core earnings are, right? And so it's situations like that where we're saying, hey, let's focus on the kinds of companies where profits actually are playing a role, where they are indicative of what the future cash flows of the business will be.
Yeah, that's a good point. And so just to recap, the things where we found it effective were consumer staples, materials, industrials, and consumers for sure. Very strong signals there. And it still worked in all the other sectors with a few exceptions like biotech, as David mentioned. So, and I was just looking back at the question that came in through the chat. I think we answered it, but in terms of when it exits, it would exit when it leaves the cutoff threshold that we have set. So, and then I think just a nuance to that, as Kevin referred to the, the overlay that we applied. I'll go back to that slide here. In those circumstances, we wouldn't really actually be updating the portfolio during that period of time. And Kevin, I forget whether we were flat or just held the existing portfolio over that time. I believe we were flat, right?
Yes, flat.
Yeah, so. All right. Well, if there aren't any other questions, I think we're going to let everybody get back to their work. We appreciate you joining us. We do have webinars from time to time about data sets that we investigate. We have a number of upcoming ones. And we'd like to encourage you to do a free trial of new Constructs data. We've got the data integrated and ready to go. And it's available for trial through our Liberator Data Fabric. We also have some additional resources here that we posted on the last page. There's the MIT Harvard white paper, which you can download from that link, and a number of other documents that we've pulled together to help understand all the great work that New Constructs is doing. I appreciate David Trainer joining us today. He's a very understated person, but he's a very experienced Wall Street veteran. And he is really, bringing his expertise to a very interesting alternative data set. Thank you for joining us, and we look forward to seeing you in a future webinar.
I'll let everyone in at like 3:01 maybe.